Welcome to the deep dive. We're here to really plunge into the source material you shared and pull out the most vital nuggets of knowledge. Today, we're diving into a really fascinating market intelligence report. It's from midday, Thursday, July 31st, 2025. And what we're seeing is, well, it's a truly remarkable tale of two markets operating on completely different wavelengths, it feels like. So on one side, you've got the tech-heavy NASDAQ composite. It's absolutely soaring up, what,
It's
1.55%,
a really strong move.
pushed by this AI frenzy, you could call it. It's charging towards a new record high.
Right.
But then you look over at the Dow Jones Industrial Average, and it's a stark contrast. It's actually in negative territory.
Right.
Down 0.38%.
Well, battling those headwinds.
Exactly. Clearly fighting persistent inflation, you
Right.
know, and the Federal Reserve's pretty unwavering policy stance. And the S&P 500, well, it's up, but just modestly, 1.01%. And that performance is, like, heavily skewed by just a few of those massive tech giants.
It really is.
So our mission today is to really unpack this unprecedented divergence for you.
And it's fascinating if you connect the dots from the sources. What we're seeing is this great decoupling. That's a good way to put it.
Decoupling. Okay.
Yeah, the market's basically splitting. You've got the AI-centric businesses over here, and then, well, pretty much the rest of the economy over there.
Huh.
And the key insight, I think, is that these AI companies, they're currently seen as almost insulated from the broader economic worries.
Insulated, how so?
Well, think about their revenue streams. Often they're creating entirely new value, right? Through intelligent automation, predictive analytics, often with these recurring subscription models.
Ah, okay. Less cyclical.
Exactly. Less tied to the usual economic ups and downs. And this dynamic means investors are placing this enormous premium on companies that have a really clear AI-driven path to growing revenue.
Got it. So it's not just any growth. It has to be AI-powered growth they're looking for.
Precisely. That's where the big money is flowing.
So you mentioned insulated. What exactly is shielding these AI firms from, say, a wider slowdown or those higher interest rates we keep hearing about? And what are the big forces really creating this split market?
Great questions. The insulation really comes down to their business models, like we touched on. Many AI companies are driving these fundamental shifts, transforming how businesses operate, powering completely new consumer experiences.
Right.
Stuff that can actually thrive even when traditional sectors might be slowing down. They're just less dependent on broad consumer spending trends, for example.
Okay.
As for the forces at play, your sources point to a few powerful currents. First, absolutely blockbuster tech earnings.
Oh.
Like Microsoft, Meta, that really lit a fire under that AI optimism.
Yeah, Microsoft's cloud growth was something else.
Just blistering. But then you have the other side. Persistent inflation. That core PCE number, the personal consumption expenditures index, the one the Fed really watches, it's still sticky. Still elevated at 2.8% year over year.
Still well above that 2% target.
Absolutely. Way off target. Which leads us to the Fed.
And if that wasn't enough, yeah, we're still dealing with a pretty hawkish Federal Reserve, aren't we? Chair Powell's been quite clear.
Oh, absolutely. Chair Powell essentially just quashed any lingering hopes for a rate cut anytime soon. It's a very clear signal. Rates stay higher for longer.
Right.
And this whole dynamic, this Fed on, Fed off situation, basically, is the Fed tightening hard, or is it signaling a pause that's really driving how capital is being repositioned right now?
Okay, so how's that playing out?
Well, as the Fed signals higher for longer, Fed on, basically money is visibly moving away from those cyclical rate-sensitive areas. Think materials, real estate, things more tied to the economy's pulse.
Got it.
And it's flowing into secular growth, primarily AI, that's the big one, but also into more defensive holdings like utilities.
And it's not just economics, is it? We can't forget the geopolitical side, the trade stuff. Your sources mentioned U.S. tariffs, for example. How do those fit into this two markets picture?
Oh, it's a critical piece. Absolutely. Because while these AI stocks seem to be defying gravity, traditional industries like manufacturing, they're grappling directly with these global trade tensions.
Yeah, right. Real-world impacts.
Exactly. Ford, for instance, is now putting a number on it. They're saying a $2 billion negative hit for the year, specifically because of these U.S. tariffs.
Well, that's substantial.
It really highlights that hugely uneven impact across different sectors.
Yeah.
You've got one part of the economy building the future with AI, seemingly sort of detached, while another part is wrestling with very tangible, very real costs from global trade policies.
So bringing it all together.
Yeah, connecting it all up. What we're really seeing is this profoundly bifurcated market. That's the word for it. Different sectors are just operating on totally different assumptions. Capital is chasing these distinct narratives, driven largely by that Fed on Fed off dynamic we talked about, moving away from rate-sensitive stuff towards clear, independent growth like AI and, yeah, into defensive plays too.
Okay. And looking just ahead, we've got some pretty significant market-moving events coming up right after the close today.
Big ones.
Highly anticipated earnings from Apple and Amazon. For Amazon, I guess everyone's watching Amazon Web Services growth.
Yeah. Can AWS match that blistering cloud growth we saw elsewhere? That's the key question.
And for Apple, it's always about iPhone sales, but also any comments they might have on those tariff impacts we just discussed.
Definitely. And then tomorrow, we get the July jobs report. That'll be incredibly important, a critical input for what the Fed does next.
Huge data point.
So this all really raises an important question, doesn't it? You've got a market running on these two completely separate tracks, one powered by like high-speed AI, the other battling economic headwinds.
Yeah.
What does that actually mean for your portfolio? And maybe more importantly, what kind of companies are truly built for resilience in this kind of divergent dynamic landscape? Something to think about.